Experts say investing in equity markets over a period of time may help us beat inflation and achieve our long term financial goals comfortably. But how do investors navigate through so many investment options, different styles, different market segments, different sectors, without getting influenced by biases related to fund performance, their own emotions, or lack of understanding? We are going to find it out from an expert who has more than 2 decades of experience in the financial markets. Usha Nair, Senior Vice President at DSP Mutual Fund. Welcome to the show, Usha.
Thank you. Thank you, Shimona.
But before we start the conversation, request all our viewers to share the questions in the comment section and we shall get back to you at the earliest. So, Usha, my first question to you is what is your observation and what is your opinion about, what kind of mistakes investors do in their investment decisions, and how do you think they can control, such mistakes?
Thank you, Shimona. Happy to be here with you to share some inputs on investing mistakes and overall how to look at planning and taking ahead your investment journey. One of the common mistakes that I have seen in my career spanning 2 decades is investors usually start making investment decisions a little late into their journey of investing. And having made that decision, that is, I must start investing, I must start saving, I have certain financial goals to reach, they get very nervous and want to fast track the journey. What I mean by that is, having missed a few years of your career or your life in taking that investment planning, you jump into investment decisions at usually the peak of the market, because a lot of times these headlines, the conversations, your friends, your family, your colleagues discussing investment returns happen when markets have delivered returns. Their investments have started yielding them good profits and you feel left out. And at that point, you feel that you want to fast track, you want to invest a larger amount so that you can cover the gap of a few years that you missed out by not making those wise decisions or those planning. And that usually what I've seen is comes towards the peak of a cycle, or a lot of narratives have already got built into the investment returns that is possible. And then you probably regret, because investments are cyclical, returns are cyclical, and it is always beneficial when you have invested for the long term. Second thing that happens usually is, one of the other mistakes is that you tend to largely bite into a thematic or the fad of the market at that point of time, which could be sectoral fund or which could be, other formats of investing, where again, headlines are making good return projections or the historic returns are great. So if you were to ask me in one line, what is the biggest mistake that investors do, is to do a rear view investing. See the past returns and extrapolate that return to be the future, and investing basis those.
Absolutely, Usha. In fact, you've stated it so rightly that investors do get influenced by past returns. And, often when I have, financial wellness sessions with various, organizations, their employees or our investors, I think that's one of the major things that come up and they discuss that. One more thing that I feel is they also get overwhelmed with so many investment choices that they have, so many different types of funds, that they look at or they start researching at. But they may lack proper understanding of these funds. So what would you recommend for such investors? How do they navigate through these choices, and what kind of choice do you think they should make if they do not have a proper understanding of the funds?
That's a very relevant point and a question that bothers a large number of investors. I would say a large majority of investors get bogged by these kind of questions. Of course, one route that an investor can always take is go through a advisor, a financial planner, an advisor who understands this and who's a professional in creating portfolios for clients, helping them reach their financial goals, etc. And they will do the homework for you and guide you through the path of investing in a proper manner over a longer period of time. But in spite of that, even if you have an advisor, it is always good to know the kind of opportunities that you have in the investing universe. And there is a large majority of schemes, funds, types that are available, and it can be confusing even for a informed investor. Leave alone a new investor or someone who is not doing this on a regular basis. Now, one of the easiest and the safest way to look at investing is to go through this category, which is called multi-cap funds. And why do I say that is one of the easiest and the better categories for most of the investors to consider is the categorization in the mutual fund industry is based on the capitalization, what we call as market capitalization of a stock. Now, there are about 100 stocks that are classified as large cap. They are the largest companies in the country. They have been in existence for many years. Their valuation or the capitalization is the top 100 companies of India, and we call them the large cap. Then comes the next set, which is the emerging businesses. They have done well, markets are aware of them, their business models are known, but they are not the largest. So we call them the mid segment or the mid cap. There is another 250 of them as per the regulator's classification, which is called as the small cap, or they are not yet into the largest league, nor are they into the middle segment, but they are the smaller companies. They would also be known companies, known business models, known managements, but in relative terms, they are called as the smaller capitalization companies. Now, what a multi-cap fund does is it allows investments into all these three categories. And there are reasons why all these three categories are important in one's portfolio. There are times when large cap companies do well and the experience would be relatively better than a mid or a small cap. But small and mid cap, when you look at historically, there has been better return experience because they are coming from a low cycle or a low growth phase, and then they capture the market, their products get sold more, so on and so forth happens. So historically, the experience for an investor usually is better, but of course they do come with their share of ups and downs, relatively more than what a large cap business will offer an investor. And a beginner investor or someone who is investing for the long term, it would always be good to have a reasonable representation of all of these three categories in one's portfolio. Now, for an investor to understand what time which will work is going to be extremely difficult. And in each of these categories, there are multiple options that are available again for the investor. So combining all of them is what this category called multi-cap funds does. They have an equal representation of large cap, mid cap, and small cap, which is 25% each. And the balance 25% can be allocated to any of these depending on the discretion of the manager of the fund, which is a category that is reasonably good for almost a large class of investors. And I would like to use a small analogy here. We all are used to, consuming bread from childhood. Now, at some stage in our life, we would have all consumed white bread. Then there came a time where the health features of the white bread got highlighted, the disadvantages. So you moved into consuming brown bread, which is more wheat-based. And, it was told to us that wheat is less harmful than consuming the white flour or the white bread. And now most of us who are conscious of health, nutritionists, everybody suggests a multi-grain bread for us because a representation of all the grains are there, and the disadvantages of one, consuming only one particular style of the bread or a character of the bread, is reduced and it is replaced with certain other good characteristics so that you get a holistic bread to consume. Something very similar happens when it comes to multi-caps. All the styles are good and you need a good representation of all of them in a reasonable proportion, which helps any investor to participate in the complete market with a formula that is derived and managed well by the fund managers.
Usha, I think you have introduced an amazing category that investors can look at, and especially people who have just started investing and they may not have a very clear understanding of different sectors, segments, and styles. But like you mentioned about the multi-cap category, we also come across other terminologies like flexi-cap category or multi-asset allocation funds. Would you want to, would you help us understand what's the difference between these funds or these categories? And are there specific set of investors for which, all of these categories are suitable, or, they're specific to a certain group of investors? That would be very helpful.
Very, very well asked, Shumona, because like we discussed, the confusion of multiple categories and multiple types will always be there. I mean, it's good to have choices, but sometimes too much of choices can lead to confusion in any product that we want to, buy or purchase or whatever it is. And mutual fund schemes are also somewhere in that because there are too many choices to make. Now, I explained multi-cap goes through a proportionate allocation, which is defined and based on these, regulators' categorization of schemes, that it should have 25% into large cap, it should have 25% into mid capitalization, and it should have into small capitalization of the 100 rupees that is invested into the fund. What is left is 25 rupees, which will then get allocated across the categories or only into one, depending on how the fund manager wishes to manage the portfolio. But the minimum allocation is 25 each to all the three categorization. So that is as per the norm of the category, and that will be followed without any, change. When it comes to flexi cap, and it's a very valid category, it is also in some nature multi, though the word is flexi cap. It means the same for an outsider or for someone who's a novice to investing. What is the difference? And I'll elaborate what is the difference there. In flexi cap funds also, you will find all these three categorizations. That is, there would be a proportion of large cap funds, there would be a proportion of small cap, and there would be a proportion of mid cap businesses. However, unlike a multi cap where a defined proportion of 25 rupees each out of the 100 is to be necessarily given, is not there in a flexi cap fund. So that flexibility, whether you want to do 40% in large cap, 20% in mid cap, and another 40% in small cap, is completely at the discretion of the fund manager, which is why it is very flexible at the fund manager level. So if you were to use at the English word, the flexibility, which is not bound with a rule, you are able to bend it in a manner which you see is prudent and appropriate. The fund manager has got the discretion to do that. While in a multi-cap fund, the rule is defined at a category level by the regulator, and all fund managers will follow that. So the ability to navigate within the three segments is only 25 rupees for a fund manager, whereas in a flexi cap, it is a little more. The entire 100 rupees of investment, he is able to navigate in a manner that you can choose to decide and choose to allocate depending on his outlook on the market, which segment he feels can deliver better returns, so on and so forth. And largely, when you look at an industry, you see that flexi cap funds, this is just a historic evidence. It is not necessary that it should be only in that manner. We have seen that they are more tilted towards large caps than multi caps because of the way the funds are structured. But do both have exposure to all the three capitalizations I mentioned? Yes. Multi-cap will have a little more of mid and small cap exposure as per the definition. Flexi cap, as history suggests, has been a little lower, but nothing prevents them from taking it up. I'm only quoting the data that is visible so far.
Understood, Usha.
Yeah, and to your other question on multi-asset, they are a very different product category altogether. I would say that the common word multi comes in all of them, which is very useful because the word multi tells you multicolor, multi-grain bread, multifaceted personality. We talk all these words. So the multi itself says characteristics or traits of different aspects. Now, what does a multi-asset fund do? A multi-asset fund does different asset classes built into the product in a manner which is, again, desired for the clients to generate long-term returns as well as risk management. So any multi-asset fund will minimum have 3 asset classes. What are the asset classes that we are familiar with? Equity is an asset class. Fixed income or debt is another asset class. Gold, commodity, silver, this is another asset class. Real estate is a 4th asset class. So as an investor, we do invest in all these asset classes, either as individual asset classes, or you choose the route of a mutual fund scheme where a good proportion of all these asset classes are brought in. So capitalization of the market is one segment. There are 3-4 categories of market capitalization: large, mid, small, and micro. While in asset classes, there are 4-5 asset classes that are familiar and which an investor can purchase, which is equity, fixed income, real estate, gold, commodities, etc. So a multi-asset fund will have all these asset classes in some proportion combined. A multi-cap fund will have all the capitalization combined in a reasonable proportion. And both are very well suited for all classes of investors. Multi-asset gives you the complete exposure to all the asset classes and you don't have to chase them independently. Multi-cap gives you the complete gamut of equity market without you having to chase large cap funds separately, small and mid cap funds separately.
I think that was a fantastic and very useful piece of information that you shared with our audience. And I'm sure they will be able to now understand what's the difference between these categories. Coming back to our discussion on multi-cap funds, how do multi-cap funds work? How do fund managers, you said that there are 25%, 25% is the allocation for each,
Yes.
caps, right? Large
Yes.
cap, mid cap, and small cap. How do
Yes.
fund managers choose the underlying securities? Are there specific criteria that they look at? Could you please help us understand that?
Yeah, sure, Shamona. So, so capitalization, as we explained, small cap, mid cap, large cap, that's more mathematical. It's a number. Top 100, you multiply the outstanding stocks into the valuation, and then you arrive at the capitalization, and then you screen it from top to bottom, and the top 100 gets classified as large cap, the next 150 as mid cap, and so on. So that's a very simple and mathematical formula, and depending on how the stock price changes, the capitalization can slightly vary, which is why sometimes you hear that this company has moved into the large cap, or this has moved out of large cap to mid cap, kind of thing. Those small changes keep happening, and there is a method to the way it is calculated and arrived at. Now, so as I mentioned, these are not 25 stocks or 30 stocks. There is a larger number. There are 100 large cap stocks, there are 150 mid cap stocks, and another 250 small cap stocks, which is part of the NSE 500 universe, the 500 stock universe that you usually talk about, which is what largely, I would say very largely, most of the mutual fund companies operate in, and you select stocks from this universe to build your portfolios. Now, how do you select from those 100 large cap stocks? How many should be part of your portfolio? From the 150, how many would be part of your mid cap? That 25% that you're allocating, and to the small cap, the 250, and then beyond kind of a structure. So within that, fund managers will look at the growth potential of the company. There are various ways to measure that. There are ROE measures, which is called return on equity, return on capital invested, the earnings growth of the companies. Then they look at matrices like how is the company doing in its sales, growth of the company. Are they doing any capital expansion? Are they entering newer markets and building their investor base or their client base? Is there a threat to the company in terms of competition coming and probably taking market share from the company's business? How good is the management, which is an extremely important criteria when fund managers evaluate businesses? What are their business practices? How is their, what is their shareholder friendliness? How open are they in their communication? So there are multiple qualitative and quantitative aspects any manager will look at when you are analyzing a business. There would be a series of checks and balances, which is called financial matrices, behavioral matrices, and growth matrices. All of these are studied, and basis which stocks or businesses are selected and portfolios are created. Now, when you do a large cap portfolio or large cap stocks, these are established businesses. They have been in the country for years. You have dealt with them. You know their, trials and tribulations, kind of a thing. When you evaluate a small cap business, they are coming to the market. They are newer businesses. Their experience in the market as an investor for the fund manager is also less compared to when you identify or study a large cap business. So you're more cautious. You look at far more nitty-gritties of those businesses to understand, should it be part of my portfolio? So your due diligence, as we call it, we use the word due diligence, will be far more stronger, robust, and checks and balances will be far superior when you're identifying and picking a stock from the small cap universe, a little more comfortable when you come to mid cap, and more comfortable when you come to large cap, because they have migrated through this channel over a period of time and your understanding is far more. That doesn't mean that you are less cautious. You're cautious because you're managing public money. The control mechanisms and the commitment is at a different level altogether. But when you evaluate, you need to study the new businesses, the smaller businesses, far more robustly than you would probably do for a large cap. In our parlance, we also say how many of these companies are tracked by analysts. There is a community of analysts who track businesses. Large cap businesses are usually tracked and reported by far higher number of analysts, whereas small cap businesses are not done to such a large extent. So the onus on the fund management team to do their due diligence is that much more higher. So this is how, from a behavioral perspective, you will look at these businesses. And beyond this, all the other measures that I mentioned are studied. The growth cycle of the company, the valuation of the company, all of these are given a lot of importance. And that is how you are constructing the portfolio. In an easier manner, Shimona, I would say that since there is large, mid, and small cap, actually the manager who manages this fund is in a way doing 3-in-1 job. He is managing part of his portfolio like he would do a large cap. Another part he is doing like a mid cap, and another part who you are doing it like a small cap fund. So the approach will also be in a way 3-in-1. Now, I hope that helps the audience to understand.
Absolutely, Usha. I think that's a great deal of work that goes in choosing the underlying securities, and you have so well explained the processes to our audience here. Before we have more conversation with Usha on this subject, to all the audience here, if you enjoy our content, please like the video, subscribe to our channel, and press the bell icon to get the latest video updates from DSP Mutual Fund. So, Usha, I also would want to understand on behalf of our audience here about the taxation structure of these funds. What kind of taxation structures would these funds have?
So, Shimona, multi-cap funds are considered as equity funds. Any fund which invests more than 65% in domestic equity is entitled to be classified as an equity fund, where a taxation is, if you hold it for more than a year, you have a 10% capital gains tax. 12 months is defined as long-term, and therefore the capital gains that accrue to you after withdrawing money after 12 months is called long-term capital gains on your capital invested, the gains that you made, which is a 10% capital gains with surcharge that we pay today. And if you withdraw before 12 months, you have a short-term capital gains, which is around at 15%, and with surcharge, cess, etc., that you pay on that. So a multi-cap fund qualifies as an equity fund because it will at all points of time have 65% investments into the domestic equities, and therefore it is classified as an equity fund, and you have the equity taxation, which is 10 and 15%, depending on whether you have held it for the long term or the short term.
Right. Also, Usha, during our conversation, you mentioned that multi-cap funds can actually be used by all category of investors. Does
Yes.
this also mean that these funds are suitable for all risk profiles? And how should investors plan their investments into these funds? Should
Yeah.
they take recommendations from from the advisory point of view? Could you help us understand that
Sure.
point?
100%. So, Shimona, that's again valid. While we say all these categories are suitable for a large majority of clients, I would encourage, almost all the investors to go through an advisory angle. And I have a reason to say that. So there are a lot of investors who may think that, we will be able to understand and do it ourselves. But like we explained, there are multiple layers of investing journey that you go through. There are different cycles that are there in the market. The styles of the funds are different. Choices are far too many. So always it is good to have an advisor plan your investment journey for you, your goal based approach, or what is the type of risk profile that you're going through, and basis which these funds or schemes can be suggested to investors. In general, multi-cap as a category solves for a lot of problems in terms of portfolio allocation, because typically you see portfolios are created around large caps, mid caps, small caps, etc., and different ideas comes into your portfolios. But there are periods of time when one capitalization will do well and another doesn't do well. So your portfolio goes through that ups and downs depending on the choices that you have made. Multi-cap largely solves for that problem where you have a fairly good representation of all the capitalization. So instead of buying multiple things, you can combine the benefit of all of that into one, is what multi-cap solves for it. Having said that, that alone is not the reason for an investor to say that this is the only product that I need in my portfolio. You still may have a higher risk profile in a category like this, which is not suitable for the investor. Or maybe somebody has the risk profile to do a far more aggressive style of a portfolio. Maybe you need to combine this with something else. So for all of these, when you go through an advisor, he does the conversation with you, assesses your risk profile, and basis that suggests portfolios for you, which can help you to make your investment decision far more superior, is what I would say.
Great. Usha, thank you so much for joining us today and helping us understand the multi-cap segment of mutual funds. I'm sure our viewers would have benefited a lot from your advice and expertise that you had shared. To all the viewers here, if you need help managing your money, click the link in the YouTube stream and we will contact you ASAP. And yes, don't forget to leave your feedback about this conversation. Happy investing.
Thank you, Shimona. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.